This report is based on a case study of an international organisation, namely Virgin Active, referred to as VA from here on. The report seeks to critically analyse a number of important strategic and non-strategic decisions at both corporate and business level that VA have taken over recent financial years. The report also seeks to examine the organisation's appetite for risk and the effects that it has on the business performance. The report will include with a series of recommendations that the author believes VA should consider during the upcoming financial years. Topics covered throughout this assignment: overview of the corporation, bones of the report, acquisition of a exporter, sales of controlling interests, focus of expansion into Asian markets, risk appetite, recommendations, summary of report. Overview of the chosen corporation, namely VA. VA's health clubs and gyms were originally formed in 1999, only opening with 3 UK health clubs. During 2011, VA acquired 57 clubs and sold 2, and opened a further 10 clubs. Their current portfolio of 259 clubs employed approximately 11,090 staff who supported over 1 million members. From such a humble beginning, VA is currently in a healthy financial position. In 2011, revenue increased by 20% to $536.2 million compared to $445.2 million in 2010, representing 12 consecutive years of double-digit earnings growth by the company. These results have been achieved against a backdrop of challenging economic environment, which underscores the strength of the business strategy. Until recently, VA was a private limited company with Branson's Virgin Group owning 76 shares and the remaining 24 shares being held by the management team alongside private equity firms Bridgepoint and Premier. But 2011 marked a significant year of strategic challenge for Virgin Active, with CVC Capital Partners acquiring controlling stakes in VA, which valued the company at $900 million. Whilst also agreeing a 30-year global brand agreement for the use of VA's brand. In a recent press release, Matthew Bucknell, VA's chief executive, defined the outlook for 2012 as both a year of growth and investment and integration of the acquisition into the brand. Here is a short video of VA's launch into Australia. The bones of the report. Throughout this report, we will consist of strategic management in the chosen organisation in 2011. These consist of acquisition of a exporter, sale of controlling interests into CVC, focus of an expansion into the Asian markets. Acquisition of a exporter. Historically, VA has grown by following a well-proven strategy of both organic growth and strategic acquisitions. 2011 was no exception, as in July of that year, VA acquired a exporter, one of their major competitors, at a very competitive price of $77.5 million, which added 53 clubs to VA's portfolio. The question has to be asked, was this a risk for VA to take, or a repeat of its previously well-used strategy? The answer appears to be latter, as 12 years ago Branson played such a sizable part of South Africa's health club market. In comparison, a exporter acquisition was a substantial coup for VA, as the exporter was valued at 150 to 200 million and owned properties worth approximately 250 million. The deal was secured with stiff competition from David Lloyd's being the most favourite to secure the deal. This decision strengthens VA's strategy to focus on premier sectors of the market, as 3 years ago it purchased 13 clubs from a exporter for an undisclosed sum, which included 7 in the UK and 6 in Spain. Exporter had positioned themselves at a premier end of the market, differentiating themselves from competitors by charging a high monthly membership fee, with the objective of creating a select members-only club aimed at the wealthy individuals with a high degree of disposable income, as stated in Exporter's mission statement. The position of Exporter's acquisitions and the positives of them: it enables VA to eliminate one of their leading competitors, it substantially increased VA's assets for a fairly low outlay, it increased VA's clients by adding approximately 154 premier members, it strengthens VA position globally against competitors. Sales of controlling interest to CVC. Sir Richard Branson's Virgin Group was a majority shareholder of 76 of VA's shares. The remaining shares belong to private equity firms Bridgepoint and Premier, and the management team at VA. VA was the UK's second biggest gym operator when they announced that Virgin Group were looking to sell stakes in VA. Branson appears to have been very confident that he had chosen the right partner, as he signed a 30-year agreement to use VA brand name as part of the transaction. It could be argued that Branson trusts CVC, as he would not risk damaging his reputation for the brand image. Transaction allowed VA to extend their banking facilities until June 2018, providing capital for expansion into overseas markets such as Asia. The importance of this transaction is that it reflected the fact Branson employed the service of Goldman Sachs, one of the UK's premier investment companies, to handle the deal. The decision to sell rather than float appears to be sensible considering the current flotation of the markets. The sale has generated substantial revenue for Virgin Group but still allowed them to retain a sizable slice of VA, which would release a substantial sum of money should CVC decide to float when the market is more stable. This decision that the CEO of CVC has not ruled out. Focus of expansion into the Asian markets. With the recent euro crisis, VA currently experiences a slowdown in revenue from the southern European operations, and as such are set to expand into Australia, intending to use as a springboard into Southeast Asia. This appears to be a sound strategic business decision, as in recent international reports on the size and scope of key health club markets, it shed a bright light on what is called the final fitness frontier, the 14 markets. These consist of Asia, Pacific region, namely Australia, China, Hong Kong, Taiwan, India, Indonesia, Japan, Malaysia, New Zealand, Philippines, Singapore, South Korea, Thailand, and Vietnam. Only time will tell if this is a good decision, but VA should be aware that Fitness First, one of their major competitors, already has a significant presence within the Asian market, but appear to have overstretched themselves by taking such a strategic global approach and are currently experiencing several severe financial difficulties. The importance of the Asian market to Fitness First industry can be seen in the decisions that Fitness First's largest lender are prepared to invest $100 million to expand their company presence in Asian markets where trading is considerably healthy. The risk appetite. Most organisations with the desire to grow need a healthy risk appetite. VA has a perception for being very dynamic with respect to risk. This can be seen with some of the strategic management decisions mentioned earlier in this report. Of particular risk was VA's move to South Africa at the time when the industry was in decline and the country was somewhat in a state of turmoil. But Branson's approach to simplify the product and open the service to the masses turned out somewhat a potential high-risk situation, and he turned it into a highly successful venture. VA has rewritten the concept of health clubs in South Africa, breaking down the class barriers. Although Branson appears somewhat cavalier towards risk, the author doubts this is a true reflection of what VA's empire is based around, the Virgin brand image. It is therefore unlikely that any risk decisions would allow to compromise his brand image. Branson's approach to his image is to mitigate the risk. If he identifies a significant decline in the market, he tends to sell the company but not the brand image. Two good examples are Virgin Records and Virgin V, which he both sold but neither exist with the brand image, whereas his confidence in the leisure and media is significantly greater as he's recently sold both with long-term agreement of the use of Virgin brand. To then conclude, recommendations. Making recommendations with VA was extremely difficult as they appear to be so far ahead of the game in comparison to other companies in their league, but the report has identified several issues which need to be handled in a strategic manner, namely 1. Closely monitoring revenue generated by their European clubs on a country-by-country basis to ensure that the return on the investment is maintained. Number 2. Closely monitoring the declining financial position of their major competitors Fitness First. If this deteriorates, there may be an opportunity to acquire some of their clubs on assets. Number 3. In integrating with the Exporter clubs into the Virgin brand, VA need to ensure that those Exporter clubs in close proximity to existing VA gyms maintain their competitive differential in order to retain the clientele who are prepared to pay a premium price. Additionally, strategies need to be put into place to ensure that significant growth is created in the premium end of the market. Number 4. Evaluate the American market and assess if there is a gap for VA to exploit. This could be strategically aligned with those cities that VA Atlantic fly into, making the group's offering more attractive to their customers. Finally, number 5. As VA moves into Asia, consider the implementations of an exchange program between club managers on a global basis. This will provide a framework for transferring the excellent levels of service to be found within the Asian markets back into VA globally. To conclude this, a summary of the report. From the evidence within this report, it can be concluded that Branson is no ordinary entrepreneur, being extremely successful in taking many of his business ventures from a humble beginning to a global success. This is clearly evident within achievements with Virgin Active. VA sustained competitive advantage stem not only from consistent high levels of customer service that are very important in the health club environment, but also from the organisation's appetite for risk and the top-down entrepreneurial approach that allows the lower-level management the freedom to act as strategic manager. I hope you've enjoyed listening to my report. Thank you.